Solo LLC, the mega winners. If you're a single member LLC, congratulations, you just hit the jackpot. Starting in 2026, the 20% QBI, qualified business income deduction, is now permanent. So let's look at some real numbers. Let's say if you're the business owner earning $100,000 in profit, you will get a $20,000 deduction, resulting in tax savings between $4,400 to $7,400 annually, depending on your tax bracket. And that's every single year. But here is the kicker most people miss. 100% bonus depreciation is back permanently. That means that if you purchase a laptop, camera, office furniture, or even a large equipment, it can all be fully deductible this year. So here's an example. A truck driver who buys a new truck for $90,000 a year can write off the full amount of the cost of this truck, potentially saving between $19,800 to $33,300 in taxes that same year. So here's the action steps for the solo LLCs. Number one, separate your finances. Open a dedicated business account. This is no longer an option. Number two, make purchases before the end of the year. New equipment or tools, buy them before December 31st to qualify for the full deduction. And number three, track everything. Every dollar spent on your business, from internet bills to gas mileage to software subscriptions, every expense, it all matters and should be documented and categorized. So here's another bonus strategy that I would like to share with you. I just gave you an example about the truck driver, but here's if you would like to scale your business, here's what you can do using the same strategy. If you're looking to scale your business, here's a smart move you can start implementing right away. You take the $19,800 you just saved in taxes by using the bonus depreciation, and you use this money as a down payment to finance another truck or a piece of income producing equipment. You will not only deduct another $90,000 and potentially save another $19,800 to $33,300, but also increase your revenue at the same time. This is how small businesses grow into the big ones with strategies, not just an effort. In the next upcoming segment, I will walk you through how solo entrepreneurs can take their tax deductions even further, including advancing write-offs, smart income shifting strategies, and how to legally keep more of what you earn. You definitely do not want to miss this, so stay tuned. Freelancers and consultants, the surprise champions. Freelancers, this might surprise you, but you're among the biggest winners in the new tax landscape. You get the same 20% the QBI deduction as large businesses, but with more flexibility and less red tape. Let me give you an example. Let's say you are a freelancer earning $60,000 in profit. Thanks to the QBI deduction, you can deduct $12,000 out of that, resulting in $2,500 to $4,000 in annual tax savings, depending on your tax bracket. And this is just the beginning. Your home office, internet, phone, computer, software subscription, marketing costs, all of these are fully deductible if you structure your business correctly. The most overlooked factor is your business structure. This is where many freelancers leave money on the table. So here's the quick win strategy for you. If you are still filing as a sole proprietor on a Schedule C, you are overpaying in taxes, period. While many advisors casually recommend becoming an LLC, I will tell you the truth. That's not always enough. In fact, I'm not a big fan of the LLC by the default. Depending on your income and your goals, an S-Corp might save you thousands in self-employment taxes. Here's an example. A freelancer earning $60,000 a year. With the self-employment tax, which is 15.3% on the full $60,000, that's $9,180 in self-employment taxes alone that can be saved. And if you're planning to scale or reinvest heavily, a C corporation might be the better long-term play for you. So as you see, it all depends on your strategy, and that's where we come into the place. Here's the action steps for the freelancers. Number 1, get your structures review. I would suggest to do this before the end of the year. Schedule a strategy session to see if you will be staying as a sole proprietor or if you will be switching to an S-Corp or maybe even a C-Corporation. This might be the best fit for you. Number 2, track and document your deductions. Use a proper accounting software. Keep your books clean and audit ready, because if IRS comes knocking, you want to be bulletproof. And number 3, think like a business owner, not just as a service provider. Build infrastructure now. That includes admin support, invoicing system, and a clear financial strategy. Okay, coming up, stay tuned and I will share how the freelancers can maximize the deductions with the smart business habits, protect themselves from the audits, and scale sustainably while keeping more of what they earn. High-income service professionals, the restricted category. If you're a doctor, a lawyer, accountant, consultant, or other high-earning service professionals and your income exceeds $394,600 for married filing jointly or $197,300 for single individuals, the QBI, qualified business income deduction, starts to phase out and disappear completely. But do not panic. While the deduction may be restricted, this is where strategic tax planning becomes your greatest asset. So here's the problem. The service businesses over the income threshold, they lose access to the 20% QBI deduction, which could mean tens of thousands of dollars in lost tax savings each year. But here's the opportunity. Smart restructuring and advanced planning can still unlock all these savings. So here's some strategies that I would like to share with you. The first strategy is the business restructuring. Create a management company. Split your operations into 2 different entities. So here is an example. Let's say entity A, it provides the personal services like medical or legal, and then entity B, it handles administrative or management services. Now, what it's going to look like? This allows you to allocate income more favorably, keeping some income under the QBI limits and optimizing the deductions. So here is an example. Let's say Dr. Sarah, she runs a medical practice earning $600,000 a year. Her advisory team restructures the practice. And now the way it looks, the $400,000 stays in the main profession entity and it's not eligible for the QBI deduction. The $200,000 is shifted to a management company owned by her family trust. Now the $200,000 may qualify for the QBI deduction and she gains $40,000 in tax deductions, saving between $12,000 to $15,000 in taxes. Here's another strategy I would like to share with you. Maximizing the retirement contribution. And the best part of it, you don't need to use one strategy or the other strategy. You can actually combine them all together. So the high-income professionals can defer income and reduce taxable income by creating advanced retirement plans like defined benefit plans, cash balance pension plans, 401k with profit sharing. Let me give you an example. Let's say a law firm partner earns $500,000 and they decide to implement the cash balance plan and contributed $150,000 annually to the plan. What it does, it drops their taxable income and allows them now to qualify for the QBI. So now the $500,000 in income minus the $150,000 in annual tax savings, now their taxable income becomes $350,000. And now they can actually take advantage of the 20% QBI deduction. That will help them to create tax savings between $30,000 to $50,000 in taxes per year and will help them to build long-term wealth. Here's the third strategy that I would like to share with you. Lease equipment and real estate strategically. Instead of owning office equipment or a building in your name or under the main entity, lease it to yourself through a separate LLC. This creates a passive income that may qualify for the QBI deduction while shifting deductible expenses and reducing your main entity's taxable profit. Let me give you an example how it will work in a real life case. A consultant creates a separate LLC that owns the building and leases to the S-Corporation that pays a fair market rent. The benefits. First, the rental income may qualify for the QBI deduction. Second, operating business lowers your taxable income. And third, total tax savings might be between $8,000 to $18,000 annually, depending on your lease structure. And lastly, the fourth bonus strategy that I would like to share with you is hiring family members and accountable plan. So here's what you can do. Pay your children up to $15,750 a year, and you will have zero income tax if structured correctly. Second, use an accountable plan to deduct home office, cell phone, internet, travel, and other business-related expenses. And third one, combined with depreciation and pension, and now you are stacking deductions. And as I mentioned before, all the strategies that I shared with you, you don't have to just use one. You can use all of them together. And this is typically what we do when we're working with our clients. Here's an example. A consultant pays her teenager daughter $15,750 for the part-time admin help and deducts it all and uses those funds to contribute to the Roth IRA for her child. This allows her to build generational wealth while saving $4,000 in taxes. And at the same time, since she started this Roth IRA and made the contribution, so any earnings, any profits that I earned throughout all these years in the Roth IRA will be completely tax-free money. Here's the action steps for the high-income professionals. Number one, review your entity structure. You might need to restructure into multiple entities, might be C corporation or S corporation combo. Number two, design a pension plan. Work with a firm like ours to build a defined benefit or a cash balance plan. Number three, analyze your income streams. Some of this income be reclassified as a QBI eligible. Number four, maximize depreciation and expenses shifting lease, equipment, or real estate. And lastly, number five, do not wait until the end of the year. These strategies must be implemented earlier in order to take advantage of them. The key takeaway, you don't have to lose the QBI deduction just because you are successful. With the right strategies, you can turn restrictions into opportunities, saving 5 to 6 figures annually while building long-term wealth. The sole proprietors, the biggest losers. If you are still operating as a sole proprietor, it's time for a serious wake-up call. Yes, you may still qualify for the sum of the QBI deduction if your income is below the threshold limits, but you are missing out on some of the most powerful tax and wealth-building strategies available to business owners. And here's the worst part. You are also putting yourself at the high risk of audit and paying thousands more in self-employment taxes than you need to. So let's talk about some numbers. Let's say $60,000 in income as a sole proprietor, then in this case, you will pay 15.3% self-employment tax on the full amount, and that's $9,180. Now, let's add federal tax to that, plus state tax to that, and maybe even some city taxes depending where you live. Then it's going to equal to the tax burden that can exceed $20,000 to $25,000 annually. Now, let's compare this to an S-corporate structure. Take the same $60,000 and break it down. Take $30,000 as a reasonable salary and the other $30,000 as a distribution not subject to self-employment tax. That will generate immediately $4,590 in savings right there, just from restructuring. So here's some red flags that I want to talk about, the IRS and Schedule C audits. Here's something most freelancers do not realize. IRS data consistently shows sole proprietors audit 2 to 3 times more often than S corporation or partnership. Filing as a sole proprietor on a Schedule C is one of the biggest red flags for the IRS audits. Now you might be wondering why. Well, first of all, they do not have proper books. They mix personal and business funds. They over-report deductions without documentation. There is no payroll structure, high deductions with the low income, home office claims, or cash-based service businesses. The result? Even if you're trying to do the right thing, you're an easily audit target. By upgrading your structure and implementing clean systems, you not only save in taxes, you also reduce your audit risk. So here's the strategic fix. Restructure immediately. And it's easier when you think. Number one, file LLC paperwork. It takes less than a day in most states. Number two, get an EIN number, and it's absolutely free. You just apply it and get it from the IRS. Number three, elect S-Corporate status if you have time to do this before March 15 for the current year. Number four, set up a payroll system. Number five, create a separate bank account. Number six, track all business income and expenses properly. Here's the final thought. Every month you wait is a money lost to taxes. The difference between a sole proprietor and an optimizing S-corporation would be $5,000 to $15,000 in annual savings or more as your income grows. Do not wait until tax season to act. Restructuring now sets you up for the savings that last a lifetime.